Hello traders, Gary Wagner here, just after 1 o'clock in Honolulu, 7 o'clock in New York. It is Thursday, July 30th, 2020, and this is the Daily Report for Gold and Silver. After 9 consecutive trading days in which we saw gold rise, today was different. We definitely saw the market fall, creating a basic candlestick pattern known as an engulfing bearish. The question is whether or not we're going to see a retracement or correction, if so, how deep, or whether or not we'll simply see the market consolidate at this particular price point. We know that we have resistance at 2,000. We know that we have support at around 1960. That is basis the December futures contract. We'll talk about our trade. We did have our stop hit yesterday in detail when we pull up our technical studies, but first to the price board. For the first time in the last 10 trading sessions, we saw gold pricing decline. We're looking at spot gold currently trading at $1956.20, putting it down $14.16 on the day. When we look at December gold futures, that is currently only down $360, $1973, and that is after trading to a low this morning of $1952. That did stop us out. We had a stop at 60. We will talk about that in detail when we pull up our technical studies. Interesting, the continuous contract of gold, which is obviously referencing the August contract, is actually priced below spot at 1947.40. Now, silver lost almost 3 full percent in trading today, $23.62. We saw the dollar decline about 0.6%, currently fixed at 92.89.5. When we look at the ETFs that we have been following, SLV did lose some ground today, giving up about 3.5%, 21.76 per share. GLD lost approximately 0.75%, 183.76. And lastly, Nugget lost about 6.91% on the day. We will be discussing stop placements for the ETFs on the last portion of our technical studies. Traders, as you know, we did send out a special trade alert yesterday recommending the initiation of long positions in both December gold as well as spot or forex gold. Unfortunately, those stops were hit today. In December gold, we entered our position at 1978.5. We put our stop in at 1960, which was effectively hit in trading last night. The drawdown was $18 per ounce or $1,800 per contract. Over the last 3 trades, we had a win for $57. We had a win for $14, and then this one, of course, a drawdown for $18. The question is, will we see the market correct at this point? If so, where could that correction go? Or will we see the market consolidate at these lower pricing before taking another stab at $2,000 per ounce? Because what is most fascinating when we look at current activity is the highs that were achieved not only yesterday but the day before, and those both came in right at around 2,000. As you can see, I have just put up a basic Fibonacci retracement. That retracement is running from these lows achieved at the beginning of June when gold was trading at approximately $1,690 up to these tops just shy of $2,000 per ounce. If we see the market consolidate, we would see a trade sideways, similar to what we saw here. But if we do see it retrace, the numbers that we would look for are as follows. The most shallow retracement, if we are actually entering a correction to see it trade back to around 1930, that is the 23.6% retracement, 1926.80. If it was to be a deeper retracement than that, that would take us below 1900 to about 1880. I personally do not see gold retracing further than the 38th percentile, but I do believe if we get any kind of a correction, it will be a shallow one based on the fundamentals at play, and that would take you to about 1930. Spot gold lost about $15 in trading yesterday and is currently tracking at 1956.74. Gold has shown daily gains both in spot as well as the futures markets for 9 consecutive days. That is up until today's trading day, when we saw both Forex and gold futures trade lower. Basically, we have an engulfing bearish pattern, and we definitely have this occurring after a defined uptrend. If we see follow-through selling tomorrow, that would be our confirming candle, and that would certainly indicate the potential for lower pricing. For that reason, my recommendation is to maintain a neutral stance in both Forex and futures, and let's wait for the dust to settle to see if the market's going to consolidate and trade sideways or actually enter a corrective period. Yesterday, I spoke about the fact that I am recommending that we enter stops to lock in profits on the ETFs that we have used to rebalance our overall portfolio. The first ETF that we're going to look at is GLD. We entered both GLD as well as Nugget on the 29th, which comes in right here. I'm marking us in at the high of the day at 166.74. The market is currently at 183.76. We have a very large gap that appears in the marketplace itself in terms of a price void. That is right in this area here. And so my recommendation is, typically you will see a market come and fill a gap. So what we want to do is to place our stop just below that at 177.25, locking in the differential between 66.74 and 77.25. The next ETF I do want to look at today is Nugget, NUGT. That is the Daily Gold Miners Index. It does have some leverage, so it is a quite volatile market when compared to GLD. Again, we entered this ETF on the 29th. I am marking us at this high at 73.62. The market traded as high as about 113, but is currently trading at 99.55. My recommendation is to place your stop at 88.66, which again is just the last ETF I do want to look at today is SLV, or silver. Each share represents 1 ounce in trading. Now, we did enter this later than the 29th. We did not enter our silver trade till approximately $20 per share. That's when silver was trading roughly at 20. We are at 21.76. My recommendation is that we move a stop to 2095. This has been Gary Wagner, wishing you, as always, good trading. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.